Hello, class. This is chapter 14, and I think I mentioned this when we started chapter 2. This one obviously comes out of order, um, but it's because I've had students tell me several times in the past that it just seems to make more sense to cover this chapter immediately after covering the financials in such great detail in chapter 2, and I tend to agree. We're already really discussing and reviewing topics and concepts that you should have learned in Accounting 120, and what better time than to keep focusing on those statements while they're fresh on our minds. And so that's what all of chapter 14 is about. So let's dig in. So the learning objectives for this particular chapter are to understand what common size financial statements are, to be able to calculate and interpret financial ratios, to be able to compare different company performances using those ratios, as well as historical financial ratio trends and industry ratios. So there's a few different areas that we're going to look at. So first things first, financial statements are there for several reasons. From an investor's standpoint, we are able to use them the same way that a doctor is able to look at a patient's x-rays or a CAT scan when diagnosing a health problem. And so, you know, someone who's looking at a company as an investment, or let's say a top management, is hearing about issues going on at their own firm, and they're trying to figure out what's going on. There's so many layers between them and the front lines. Maybe they're confused as to why there's, something's happening, and they only have data to tell them why, right? So we can actually look to items like the income statement and the balance sheet to tell us why we might be suffering in one area of the firm or another. Okay? And the two most important documents are going to be the income statement and the balance sheet. And luckily for you, um, you've just learned or refreshed your memory on both of those items in great detail in chapter 2. Okay, so how do they come in handy for ratio analysis? Uh, well, the income statement has periodic reporting of the sources of revenue and expenses, so we can compare both. It's very important when you're trying to see why a company might not be performing up to par. And the balance sheet provides a snapshot of the assets, liabilities, and owner's equity at any given point in time. Okay, so both very important pieces of material that we can use to diagnose the health of the company. Okay, and it's very important to note that um, financial statements and financial statement analysis um, are almost always, how can I say this? They're almost always used relatively. So, how do I mean that? What do I mean? Uh, Being able to calculate a piece of information, I don't want to get too granular just yet. Um, Being able to calculate any figure for a company doesn't really help if you can't compare it to something. So it's all relative, okay? Uh, and so one of the first methods that we talk about in this particular chapter is benchmarking, okay? So, the financial statements that we were just talking about are very complex documents, okay? They can tell us anything about any piece of our company, whether we're talking about the assets, the liabilities, the equity, revenues, just like I said. We can look at any piece of information, but if we can't compare it to some other piece of information, those lone figures really don't mean that much. Okay, and there's several different types of benchmarking that we can do. Um, One of the first and one of the most common methods is to compare a company against its own performance, right? And you should have learned about this um, in Accounting 120, this style of benchmarking. This style uh, is also used when you are doing projections, right? So if you might remember from Accounting 120 that you are projecting what you think your revenues and expenses are going to be. And then after you look at those projections, let's say a year goes by, you calculate the variance, right? And so what this involves is trend analysis, looking backward 3 to 5 years, determining growth rates and using those growth rates to make future projections. Okay, so this is the most common use of benchmarking at any firm. And it's good for looking at yourself internally. However, what you'll learn in this chapter is that you can only go so far with this style of analysis. So your book gives you this example. Uh, so we have Cogswell Cola, and um, this information is the basic information that you might see um, on an income statement. And as I was saying before, um, if I was to only look at 2013, and I would say, well, I had net income of, let's see, it says it's in thousands, so that's about 2.9 million. But that knowing that doesn't really tell me anything, right? Unless I'm able to compare it to another year or a set of years. And so that's where trend analysis comes in. I really need to know um, the data for all of these items across 3 to 5 years in order to tell if something good is happening or if something bad is happening. And so that's what this figure shows you, is it shows you that what's going on is I'm seeing growth, right? So for example, let's look at just sales and cost of goods sold. So while my revenue stream has increased at an average annual rate of 8%, um, my cost of goods sold is outpacing that revenue stream by 2 additional percent. My selling, general, and administrative expenses are outpacing my sales by an additional two, so at 4%. So what does that tell me? It means that my revenue stream is rising, which means I am reaching more and more of my market share, but I might not be doing so as efficiently as I thought I might have been, right? And how can I say that? Well, because my cost of doing business are rising faster than my sales. And so there might be some areas that I need to look at to be able to make myself stronger, if you will, and more efficient. So remember, if you go back to Business 110, a company can be effective at doing what they do, and they can be efficient. What we strive for is both. And what it looks like this company has done is they've been more effective at increasing sales, but they have not been more efficient as those sales have increased because they're incurring more cost year over year. Okay, so that's just an example of how we can use benchmarking to see what's going on with a particular company. Okay. Another useful way to make some sense out of all of this is to recast the income statement and balance sheet into what we call common size statements. Now, why would I want to have what we call a common size statement? Well, common size statements recast the information that I'm working with into percentages. Okay, and why would I want to look at percentages instead of looking at real dollar figures? Well, this comes in most handy when I'm wanting to compare myself or my company to another company who is either doing much more business or much less business than me. But I want to see how I am performing compared to them um, on a proportionate playing field, if you will. And the only way to level that playing field is to recast everything that I've done with my business and everything that someone else has done with their business in a percentage basis, because then it tells me how good I'm performing proportionately to them. Okay, so your book gives you this example here with Cogswell again, but we're looking at Cogswell as compared to Spacely, right? And what this does is, even though Cogswell does considerably more business than Spacely, what it allows me to do when I make these conversions to percentages is it tells me that Spacely isn't all that different from Cogswell. Um, because even though, I may be tripling their revenue stream, when you convert their cost of goods sold, their selling general administrative expenses, depreciation and whatnot, um, what I see is I see proportionately they're kind of like a small version of me, and so I can see whether or not they're performing better or worse than me by doing a side-by-side percentage analysis. Okay, so this is referred to as common size comparisons, income statement comparisons, balance sheet comparisons. And it's really neat because it allows me to compare myself to folks that otherwise I might not be able to compare myself to. As you can see here, we can do the same thing for the balance sheet. So even on the balance sheet, we can convert everything to a percentage, right? And then see how well we are or are not performing based on a percentage basis. And the same rules apply here. Um, it's really a good starting point for any manager who is trying to detect trends, if any, in a firm's performance, um, as well as make quick comparisons of key financial values with any competitors on a relative basis. And relative is the key term, okay? Because again, we would switch to using this style of comparison if we had two firms competing in an industry, but they're not really the same size. Maybe they're not operating with the same level of a market share, but we want to do a side-by-side comparison to see how things are going. Um, if we want to do a more in-depth diagnosis, um, then what we need to do is we need to do individual item analyses and comparisons using ratio analysis, which is what the rest of the chapter is on. But this is kind of like a good starting point to understand why managers and or investors would ever want to look at these side-by-side comparisons. Okay? Oh, and there's what I just said. Sorry, I guess I could have been on that page, but it's just echoing what I just said, so we're going to keep moving. Okay, so what are financial ratios then? Okay, financial ratios are relationships between different accounts from the financial statements. Usually, again, most of the information, not all of it, but most of it is going to come from the income statement or balance sheet. Okay, and this information serves as performance indicators. Uh, and what they do is they're relative values and they allow for meaningful comparisons across time between competitors and even can be used to measure industry averages. Okay, so all of these are very important when considering a firm's performance. Okay, and they can be broken down into 5 separate areas. Let's see. Yep. All right. So your next slide actually summarizes before we dig in, which is good. All right, so it's very important to understand what each of these areas means. What is it talking about? Okay, so the first area of ratios that you're going to learn are called liquidity ratios. And what liquidity ratios do is they tell us how quickly a company can meet its obligations over the short term. And I think I've used this term before. Liquidity means how quickly can I convert my assets to cash, right? Because if I need to be able to satisfy any debt obligations, then I need to be able to convert any assets that I have to cash very fast in order to do so across the short term, and that's why they're called liquidity ratios. Then there's solvency ratios. They're also known as financial leverage ratios or sometimes called debt ratios. Um, what these ratios tell us is how quickly a company can meet its obligations over the long term. Okay, so it's looking at a different set of criteria um, that is asking the question, are we going to be able to pay off our debt? We've taken on leverage. Leverage is a good thing as long as you know what you're doing and you got your cards lined up right. However, you can over leverage. You can spread yourself out a little too thin, and that's what the solvency ratios tell us is if you have accidentally taken on too much leverage. Okay. Next comes the asset management ratios. These ratios tell us how efficiently the company is managing its assets to generate sales. Okay, so if you have this large asset portfolio and you've made a lot of investments, how well are those investments performing? So basically, did you invest the company's money and did you get the results that you claimed you were going to get after those investments were made? If not, then you're going to find out in the asset management ratio area of the firm if those investments are not performing up to par. All right. The next section is the profitability ratios. How well has the company performed overall? So this is all things considered. How well are we performing from a profitability standpoint? And then last but not least, there's the market value ratios. And these are the ratios where some of your information is not going to come from the balance or income statement. It might come from somewhere else. But these are the ratios that tell the market, as in the investors, how they view the company's financial prospects. So, do the investors see the company in a confident way, or are they getting a little less confident in the company? And we can actually tell that by looking at stock information, the price to earnings ratio, and so on. So, we're going to talk about a few of them in this chapter as well. This also, the very last thing that you're going to look at in this chapter is the DuPont analysis. This is analysis that actually brings together three separate ratios, but it enables managers to pinpoint where poor performance might be coming from, because those three separate ratios come from three different areas of the company. And so managers can look at the DuPont analysis, they can break it down, and they can determine very quickly where poor performance is coming from, which then leads to future and further investigations. Pardon me for a second while I take a sip of water. Okay, sorry, I had to kind of get my voice back for a second. I feel like I'm losing it today. All right, so let's talk about this first group. The first group of ratios are, again, referred to as the liquidity ratios, which talk about short-term solvency. Okay, so remember, they measure a company's ability to cover its short-term debt obligations in a timely manner. And there are three separate ratios that we typically look at to see how a company can do this. And they're kind of the same and slightly different. All right, so there's the current ratio, there is the quick ratio, and then there is the cash ratio. Okay, the current ratio takes the current assets of the company and sets them against the current liabilities. Okay, so essentially what it's doing is it's saying, how did my current assets size up to my liabilities? And it's very important to understand that each one of these ratios removes something or discusses something slightly different than the one before it, because remember, it's all about liquidity. Okay, so the first one looks at all current assets. Some of those are not going to be as liquid as others. Some current assets are going to take a little bit longer to convert to cash than others, but this is still a good first ratio to look at. So technically, all current assets can be converted to cash, and so we can look at that ratio first. Then we take a step down and we say, okay, there's also the quick ratio or acid ratio test. What that does is it says, well, we're going to take all current assets minus inventories, and we're going to look at how quickly those assets minus those inventories so they don't have to be sold. And we're going to see how quickly we could satisfy our debts in that manner. Okay. Then there's the last one. The last one is just the cash ratio. So let's say I want to know how quickly a company could satisfy their debts only using the cash that they have on hand. Okay, this means that the company would have to have a lot of liquidity already available, because this doesn't involve converting any other current assets to cash. It literally just looks at the cash only. Okay, and so as you can see, each one of these ratios discusses a different manner of liquidity, but it kind of tells investors and management how well they're doing all things considered. Now, what your book does is it does a side-by-side comparison because, again, these ratios don't really mean anything if we're not comparing them relative to something else. So the example it gives you is Cogswell versus Spacely, and we see these ratios calculated for us already. And what we see is that Cogswell has a better liquidity and short-term solvency than Spacely, but higher investment in current assets means that there are lower yields being realized since current assets are typically lower yielding. So what that tells us is that even though right now it looks like Cogswell might be better off, we probably need to look at a few other areas and interrelated effects of the firm's various accounting terms before we can really make a call on whose performance is better. But this is a good starting point at the bare minimum. What it also tells me is that, I mean, we know that Spacely is a much smaller company. It tells me that Spacely is still keeping a pretty substantial amount of cash on hand in case they need it. So even though they might be not be as investing as much money into uh, current assets, like so capital investments, they're still maintaining a pretty substantial amount of money to satisfy their current obligations, which I see as good financial management. Okay, let's keep moving. So then the next step would be to look at long-term solvency. These are the financial leverage ratios that we talked about before. Okay, these ratios, again, they measure a company's ability to meet their long-term debt obligations, okay? And they are based on overall debt level and earning capacity, okay? So the failure to meet any interest obligations could put a firm into bankruptcy. And so what we want to make sure is we want to make sure that companies can always satisfy their long-term debt. And we have three different ratios that we use to do that. First, we have the debt ratio. The debt ratio takes total assets, removes total equity, which then gives us total liabilities. And remember, that's your accounting identity, and it divides by total assets. So from a bird's eye view, essentially what this ratio does is it basically tells us if we were to take all of a company's debt and then put it up against all of a company's assets, how well would they be able to satisfy those long-term debts if something bad were to happen? Would they be able to satisfy those debts across the long term? Now, remember, this is total liabilities and total assets, not current. Current or more short term. Remember, short term in the debt world is anything under a year. Long term is anything beyond a year. Okay. Then there's also the times interest earned ratio. Now, what this does is it takes the earnings before interest and taxes in a given year and it puts it up against the interest expense for that given year. So what we're looking at here is we're looking at pieces from the income statement and we're saying, okay, if you think about it, your earnings before interest and taxes are all your operating it's your operating profit margin after depreciation has been removed, and it's saying, okay, how much money did you make this year, and were you able to satisfy your interest expenses, and how many times over were you able to satisfy those interest expenses? Okay, and the cash coverage ratio is essentially the same thing, but not writing off depreciation, so it includes that depreciation expense. Okay, so the only difference between the times interest earned and the cash coverage ratio is time interest earned removes depreciation while the other one includes it. And again, these are just different ways to look at the same information to see how well a company is performing. Now your book again uses Cogswell and Spacely as examples so that you can see how this information is used. Okay, and what you can see by looking at this table is that when it comes to debt or leverage, Cogswell is in a much better position than Spacely because it has relatively less debt and significantly greater ability to cover its interest obligations. It doesn't matter if you're looking at your times interest earn ratio or your cash coverage ratio. In either case, it's doing a significantly better job. Why are we able to say this? Well, basically, what these figures tell us, you have to remember that you're not just doing fractions, you're not just doing division, these are ratios. And so I would remind you that when you look at, say, for example, Cogswell Cola's 28.34 here, what that means is 28.34 to 1, right? Because it's a ratio. It's been simplified down to 28.3483, but it's really like colon to 1. And that means that when we look at the earnings before interest and taxes, they are able to satisfy their interest expenses for the year 28 times over to 1, right? So that means that they could literally pay their interest expense for that given year 28 times with the operating profit margins that they were able to generate, whereas Spacely is only able to satisfy theirs 6.8879 times to 1, right? And we can say the same thing for the figure just beneath that, for the cash coverage ratio. Cogswell can, if you include their depreciation expense, which is really a write-off, which means it doesn't really impact their cash. So if you consider all cash generated for that operating year, they could actually satisfy their interest expense 34 times over, as compared to only 9.7 times over for Spacely. Okay, now when we look at their debt ratios, um, Cogswell has a smaller debt ratio than does Spacely. Well, in terms of debt to assets, that's a good thing because that means that we're using less leverage, right, to be in business. So the smaller your debt ratio is, the less debt you have incurred to pay off all of your assets. So that means that Cogswell is basically outperforming Spacely in every way, shape, or form in this area of evaluation. Okay, let's look at the next round. Oh, hold on one second. Gotta move down my notes. Okay, now we're going to look at asset management. Now remember, these ratios measure how efficiently a firm is using its assets to generate revenue. Okay, or they might be looking at how much cash is tied up in assets such as receivables or inventory, because those are also good things to note. Again, these ratios are not only used by investors, they're also used by management to find out if we are performing poorly in a certain area. And those are two really good things to know. One about, do I have money tied up in accounts receivable? Or two, do I have a lot of excess inventory? Those are all really good things to know. Okay, so the first one we have here is our inventory turnover. Our inventory turnover ratio looks at the ratio of cost of goods sold to inventory. Okay, and so what that basically tells me is, am I turning over the same assets that I generated in this given year, or is my inventory outpacing my cost of goods sold, which means uh, I'm not creating enough fast enough, or vice versa. So it's very important for me to be able to understand whether or not I'm turning over my inventory as quickly as I need to be. Okay, there's an additional ratio that tells me this as well, and that is the days sales in inventory, which takes, first you have to calculate the inventory turnover, but then I can actually see how often I'm turning that inventory over in a 365-day calendar year. Okay, so these are two very important ratios that we can use as managers, because first I can see if I'm keeping up with demand, and then two, how often is my inventory turning over in a calendar year. Okay, then the next two ratios are the receivables turnover and the days sales in receivables. Again, you must be able to calculate the first in order to find the second. But what this tells me is how good am I as a company at getting the people who have charged something to account to pay me? Um, so basically, I have sales, and sales are great, but if a portion of those sales are being charged to account, which means I actually haven't been paid. And so, how quickly am I able to get those who are charging purchases to account to pay me? And then, how often are those receivables being turned over in a 365-day year? Am I able to get people to be able to pay what they owe me every 90 days? Or is it every 6 months? Is it every 9 months? These are all very important things to note because I don't need money tied up in accounts receivable. Okay. And so those are also two very important areas that I might want to look at. And then last but not least is total asset turnover. So this is just more of a bird's eye view, much larger ratio that looks at total sales to total assets. So again, if I'm just curious about the profitability of all of my investments, then I might want to say, okay, what is the ratio to sales to assets? Uh, the higher this ratio is, the better, because that means that I'm having strong performance as compared to my investments. The lower it is, the worse it is. Okay, so that's what that last one talks about there. And then once again, we're going to look at Cogswell and Spacely to get like a hypothetical example. Okay, so what you'll note here is we have side-by-side comparisons. All right, and we're going to look at a few different things. First, we're going to look at the inventory turnover. So what we see here is we see that Cogswell is actually turning over its inventory twice as often as Spacely, which means that it's probably having a twice as many sales, which we would expect, right? They're the bigger company. But we're also seeing that its inventory is turning over every 42 days as compared to Spacely. So from an asset management standpoint, that means that Cogswell is actually outperforming Spacely. Okay, then we're going to look at receivables turnover. Okay, so our receivables turnover is actually opposite. So here is a situation where Spacely is outperforming Cogswell. So Cogswell's receivable turnover is only 9-1, whereas Spacely's is 18-1. Remember, these are all ratios, so it's a 9-1, 18-1. So how does that translate into days sales and receivables? Well, what it tells me is it tells me that it takes Cogswell on average 36 days to collect accounts receivables. Um, However, it only takes Spacely almost half that time, 19 days, to collect on their accounts receivable. Okay, and so here is an area where Spacely is outperforming Cogswell. Okay, and then we can look at total asset turnover. Now remember, I said before that what we want to see is a larger number here because we want sales to outpace assets because that's what we hope to do as financial managers is we hope to make investments in assets that then generate more sales. So for Cogswell, we have a total asset turnover of 1.06, but what we see here is that Spacely is actually outperforming Cogswell from this asset management standpoint because they're actually generating more sales when compared to the assets that they've invested in. So here we are finally starting to see a few areas where Spacely is outperforming Cogswell. Okay, so far so good, hopefully. All right, so we're going to keep moving. The next section is on profitability, because remember, profitability is slightly different than asset management. So don't get those two confused. Profitability ratios look at things like net profit margin, return on assets, return on equity. Basically, they're measuring a firm's effectiveness at turning sales or assets into profits. Remember, there is a difference in sales and a difference in profits. We talked about this in chapter 2 when we were looking at the income statement. A lot of people forget that sales are not profits. Sales are just that, they are sales. Profits happen at the bottom of the income statement, right? And so that's why this first ratio, the profit margin, talks about net income to sales. So it looks at all the money that you're able to generate in sales in a given year. But then after you've removed everything, right? If you think about the income statement, you have to remove the cost of doing business. You have to remove any depreciation expenses. You have to remove any interest expenses because those involve investments in assets. They involve uh, debt. And you have to say at the end of the day, what net income are you walking away with? What's your true profit margin? And so the way to find that is to take your net income for any given year and put it over top your sales for that same year. Okay. If you're interested in looking at profitability over assets, then you would then take profitability or net income and put that over total assets. And the same thing goes for profitability over owner's equity. So remember, as you grow, you have to give up ownership to inject more capital, or you have to borrow debt, one or the other. And so, what this last ratio tells me is it says, okay, if I give up ownership in my company, how much profit am I turning over for giving up that ownership stake? So it takes profitability and puts it over the total owner's equity. Okay, and again, we're going to look at some examples here. So when we look at Cogswell, we see a profit margin of about 13%. Now remember, these are ratios, so we can look at them as a 0.13 to 1. So what does that mean exactly? You might look at that and say, well, that's just a number. Well, what that tells me is that about 0.13. Let's see, how can we articulate this? What it basically means is it means that about 13% of all sales result in actual profit. For Spacely, only 10% of all sales result in true profit. And so, from a profit margin standpoint, Cogswell is outperforming Spacely. So far, so good. All right, when we look at return on assets, again, we're looking at total profit over the total assets that we've invested in. Okay, and so from a profit standpoint, Cogswell is once again generating a slightly higher advantage. It basically states that 14% of all profits are represented by our total asset stream. Same, and then when we look at Spacely, only 11%. All right. And then last but not least, return on equity. We're seeing pretty much equal across the board here, um, that there's a 3% difference between the two companies. So about 35% of my profit stream can be accounted for by giving up ownership, whereas only 32% of my profit stream can be accounted for by ownership, equity ownership, by getting a return on giving up that ownership in my firm. And so from a profitability standpoint, Cogswell is basically outperforming Spacely on all fronts. Okay, let's keep moving. Hopefully my voice will hold out a little bit longer. So the last area that we're going to look at before we look at the DuPont analysis is market value ratios. Now these ratios, you're going to have to look elsewhere. It's not just the income statement and the balance sheet. We do pull information from there, but we also have to look outside. A lot of times we may have to look at the 10K, which is the annual statement, or maybe the problem, they'll just give you a few extra pieces of information. I think that's what they do for your homework and for your quizzes. But what these do is these gauge how attractive a firm is to future stockholders, right? Or current ones even. Okay. And so let's look at each one of these ratios to see what they really talk about. So first, there's the earnings per share. Now, this one should sound pretty familiar. Basically, what you do is you take net income and you divide it by the number of shares outstanding. Because remember, when you get down to net income on an income statement, you basically have a choice. You could take all of that net income and issue it out as dividends, which means that all your shareholders would, you know, get a payout for that year. Or you can decide to keep some of it for the company to inject it back into the company for growth. But earnings per share is just basically assuming that everything might be a dividend. It doesn't mean it's going to be a dividend. It just means, like, hey, if we were to take all of our net income and shell it out as dividends, what would that figure be? So it takes your net income okay, which is also kind of referred to as retained earnings, and it divides it by the number of shares outstanding. And basically, what that tells us, what that would be if the firm were to give everything out as dividends. From there, we have the price to earnings ratio. Now, why would I want to know this? Well, I would want to know this because in most cases, I'm not going to get those dividends. What's really going to happen is there's not going to be a dividend at all, or there's going to be a small dividend, but then there's going to be an injection of the rest of those retained earnings back into the company for growth. Now, does that mean that I don't get to see those retained earnings in my ownership stake in that company? Not at all. Because as companies grow, the price per share of the company grows. And so I still uh, am able to absorb that capital in the ownership stake I have over that company because the price of the stock I own is rising. And so, what the price to earnings ratio tells me is it looks at the price per share of a share of stock and it puts it over top of the earnings per share in a given year. Now, the higher the P to E ratio is, the more attractive a firm is because it means that we're expecting higher earnings per share in future years because people are willing to pay more money than they ought to. If you think about it, logically speaking, you should not be willing to pay a higher price per share than whatever the earnings are per share unless there is expected future growth happening, right? So we see this with growth companies all the time, like Google, Amazon, you name it, these big tech firms that are growing year over year. You don't see dividends, but you do see high P to E ratios, and it's because there's expected future growth, and people are trying to get in on the ground floor while the price of that stock is lower, even though the earnings per share is significantly lower than the price per share. Okay, and how can we measure that? How do we know if a company is continuing to grow? Well, we have the price to earnings to growth ratio, which takes the price over the earnings per share, which is the previous ratio that we just calculated it, right? And we divide that by the earnings growth rate. Now, what that tells us is it gives us a growth rate over time. So then we can actually see if that price to earnings ratio is growing rapidly, slowing down, speeding up, you name it. Is it stagnating? And that gives us an idea of whether or not growth is happening. If it is happening, is it happening quicker? Is it happening slower? Should I still be interested in this company? Is it worth the buy? And so on. The last thing is the market to book ratio, which looks at the market value of a share versus the book value, which is the intrinsic value of a company. Now, the market value of a share is the price that it sells at right now, and it's ever changing. Remember, in the stock market, stock prices are constantly changing every single second. So, this is a tough one because you really just have to grab that snapshot of the price per share right in this moment and run with it. But the funny thing is by the time you get done calculating this ratio, it could have changed, but it's still there, and it is a reasonable ratio to use because what it does is it tells me how attractive a company is as it relates to their book value. Now, where does their book value come from? Well, their book value, let's see if they have it on your next page. Oh, I was hoping that they would have it on your next page, but they do not. That's okay though. Your book value comes from your balance sheet and then dividing the total value of the company by the number of shares outstanding. And we will come up on a problem like that during our class when we're doing work problems, and I will show you where to find that information. Okay. But basically, what that tells me is how attractive a company is on paper versus how attractive they are in the stock market. That's where that comparison comes from. Okay. So, what potential investors and analysts do is they use all of these ratios to complete a valuation analysis. So, if a firm has a high price to earnings and a high market to book value, that is a good indication that there is very strong, attractive perceptions of the market for a firm's performance. But if these values get too high, that can also mean that the firm is overvalued, which means that you might see a turn where maybe market attractiveness got a little carried away. Maybe too many people started buying into that company, and so you might see a reversal. Okay, and so these are all really good figures at understanding what's going on with a particular company or companies in an industry and investment in that company or in that industry. Um, when it comes to the price to earnings to growth ratio, we actually hope that that one is going to be lower because that means that you're getting that company at a bargain because the growth expectation is lower. When it's higher, that means you might not be getting it as at good of a bargain because that means that it's growing rapidly. Again, we'll do some examples of this because we're going to practice actually calculating all of these ratios during class and then using the information that we've calculated to make some conclusions. Of course, here we go again. They've given me a slide that goes along with my notes. Okay, so looking at the example of Cogswell versus Spacely, the ratios indicate that investors in both firms seem to have pretty good expectations about their performance and are basically paying fairly high prices relative to their book values. And so there's not really one that's outperforming the other. However, we can see that the price to earnings ratio is slightly higher for Cogswell than it is for Spacely, which means that people are willing to pay a little bit more dollar versus earnings to buy Cogswell stock. Also, Cogswell's growth rate is slightly higher than Spacely's, which means that future performance is growing more rapidly at Cogswell. But we do have to remember that Spacely is a smaller firm. And then the price to book is slightly higher. So once again, while they're similar, it looks like Cogswell is slightly outpacing Spacely, which is totally okay. All right, so this is the last section for this recorded PowerPoint lecture, and that's the DuPont analysis. So what is the DuPont analysis? Well, a long time ago, a guy came up with the ability to piece together different ratios to come up with one figure, and that one figure actually represents the return on equity. But what's interesting, and we call this the DuPont formula, but what's interesting is that the return on equity of any given firm can be broken down into three ratios that we've now learned about. Okay, so the first one is net income over sales, which is also known as the profit margin, or we can refer to this as your operating efficiency, right? Because at the end of the day, what this tells you is how efficiently are you turning your sales into true profit? Because remember, sales is all the money that you generate in a given year, but net income is the true profit that you are able to generate after you remove the cost of doing business. So that means that the higher this ratio is, the more efficiently you are operating. Okay, so that's one piece of the puzzle. Then there's the asset management efficiency, which is measured by our total asset turnover, right? And so what we do is we take all sales and we put them over all assets, right? And what we hope for is we hope to see a high return on our investments. Okay, so the stronger that ratio is, the better we are performing, the more efficiently we are performing and making good investment decisions in the assets that we're investing in. Okay, and then last but certainly not least is our financial leverage. This is also often referred to as the equity multiplier because what this ratio does is it tells us how good we are at taking on debt to be able to fund assets, right, and then basically pay those back off, right? So remember that while it is possible to be in business without debt, when a company does take on debt, they're able to multiply their equity by using someone else's money. and then returning it to them, but generating a high enough profit margin. Pardon me, my voice is really going here, guys. If they're able to generate a high enough profit margin, they basically are making money with someone else's money. And so that's a very important piece to the puzzle. Now, what's interesting is that while these three can be expanded outward, like while return on equity can be expanded into these three ratios, you'll notice through the use of very elementary algebra that you can cancel out sales here and here, total assets here and here, and that's why you see net income over equity. So basically, what the gentleman did who came up with the DuPont analysis is he realized that while return on equity can be calculated simply by taking net income and putting it over equity, it can also be broken down in a way that tells us where our performance might be slacking off, if you will. So by being able to break this same equation down into this manner, it can tell me, like, if I have a poor operating efficiency, but I have strong figures in asset management and uh, my equity multiplier, or my leverage, if you will, then that tells me as a financial manager that, hey, this is where I need to be looking deeper and doing more investigation, which is why this formula is so helpful, okay, when it comes to looking at a company as a whole. Okay, so again, it gives an example using Cogswell and Spacely. So we go back and we take that return on equity that we calculated earlier, but we break it down into these components. Okay, and what we see from this is that Cogswell is better at operational efficiency. It's better able to move sales dollars into income, but Spritzer is more efficient at utilizing his assets. And since it's using more debt, it's able to get more of its earnings to its shareholders. So it's using that equity multiplier, right? It's more levered. But remember, you're using borrowed money. And as long as you're able to generate a high enough profit stream, that turns into equity, not only for the business, but for the shareholders. And you're generating that equity using borrowed dollars. Okay. So you wouldn't be able to see that if you didn't have this DuPont formula. It allows you to look at each piece of the puzzle from a different standpoint and to really look at operational efficiency, leverage, and asset management all in one piece. And that's why it's so important to get all the way to this point, because you have to really look at the overall performance of the firm in every one of these areas before you can really start to reach the conclusions that need to be reached and make recommendations that need to be made for the future of a company. All right, and I think that's the end of the examples. Um, so the external use of these financial statements, especially for public traded companies, basically what they do is they provide the raw material for analysts and investors to make investment decisions. So there's two sides to every coin. From a management standpoint, it allows you to steer the ship, but from an analyst or an investor standpoint, it allows you to decide whether or not you want to invest your money in a particular company. Your chapter goes on to use Coca-Cola and Pepsi as another example, but it does exactly what we just did with Cogswell and Spacely. So I'm going to let you take a look at that. And then when we come together as a class, we're actually going to do a real example with a fake company that's provided by your book. So that's all I've got today. We'll see you soon. And hopefully my voice will be back then. Okay, bye.